That year, it felt as if the entire market had its oxygen suddenly ripped away. Panic doesn't start with news. Panic starts with people. Someone's hand shook while clicking their mouse. Someone stared at the screen like reading a death notice. Someone cursed their fund manager. Someone silently shut down their trading app, pretending the day didn't exist. Prices fell like a kite with its string cut. Straight down, no resistance. Every second came with the sound of another company hitting limit. Down like artillery firing one after another. Even in restaurants, people were talking about the crash. Taxi drivers were cursing the market. Even analysts, usually calm, were knocking on my door, their voice dry like sand. Should we run? And in the middle of this collective meltdown, I saw something that didn't belong to that day at all. Buffett sat in the corner of his office, sunlight falling across a financial statement in his hands. He wasn't watching the tickers. He wasn't frowning. He wasn't rushing through pages. That scene looked like a lantern in the center of a storm, dim but impossibly steady. I stood at the door for a few seconds, stunned. Outside, the market was screaming, but he was studying something that clearly wasn't in a hurry. He looked up, saw me, and said something I've never forgotten. In the same tone someone might use to ask whether I'd had breakfast. Do you smell it? The air is full of discounts. I froze, prices collapsing. Blood everywhere, and you tell me this is a discount? He smiled, then added something quieter and even sharper. Son, panic isn't a problem. Panic is when people throw good things on the ground for you to pick up. That was the moment I understood something. The same crash can look like the end of the world to most people, and a gold mine to a very rare few. Outside, people were running, selling, screaming. Inside, he was waiting. Like an old hunter who knows the animals always run straight into the trap when they're scared. I heard keyboard alarms, news anchors on the verge of crying, room after room of, "It's over. It's over," but only his sentence cut through all of it. Panic is the real bargain. That was the day I learned. In the eyes of a value investor, a panic day isn't a disaster. It's the day gold falls from the sky. The market has never been a precise machine. It's more like a huge public square. When enough people gather, emotions spread faster than logic. Panic is exactly that kind of spread. It doesn't start with big events. It starts with the look in people's eyes. One person panics, 10 follow, 10 panic, 100 begin to doubt. And when 100 people start running in fear, even the strongest, most solid, most durable companies, all get thrown out together. Munger once said something that cuts sharper than a knife. When the market panics, no one bothers to separate gems from rocks. They just want to throw everything away. He said this while pointing at the chart of a company whose stock had just collapsed. This business had stable cash flow, strong customer stickiness, a deep moat. Yet during panic, its stock chart looked as if it would disappear by tomorrow morning. Why does this happen? Because during panic, humans don't think. Humans imitate. Fear overrides analysis. Emotion overrides valuation. Survival instinct overrides logic. An old Eastern saying describes it perfectly. When the crowd is frightened, they lose the ability to distinguish horses from cattle. In other words, when emotions hijack judgment, people stop caring whether something is good or bad. And this is exactly the opportunity for a value investor. When emotion becomes the dominant force, Whether a company is good or bad becomes irrelevant. If people are selling, they're all selling. When everyone is running, price becomes meaningless. Selling becomes contagious. At that moment, almost no one cares about true value. Financial statements haven't changed. Cash flow hasn't changed. Customers haven't left. The core business hasn't broken. Only emotion collapses. And emotion is the easiest thing to collapse. It's also the easiest thing to exploit. Munger once tapped the table and said, "Panic is a coupon book handed to a very small group of people, but most people are too scared to even open their eyes." This is why good companies don't get cheap when markets are strong. They get cheap when markets go insane. Not because the company became worse, but because panic doesn't discriminate. It drags everything down. This is the true nature of panic. It's not a collapse of businesses. It's a collapse of judgment. It's not that good companies suddenly turn bad. It's that human nature breaks first. And in Buffett's system, the place where human nature breaks is exactly where the gold falls on the ground. To most people, panic is a disaster. To Buffett, panic is an X-ray. It reveals the true structure of a company more clearly than any bull market ever could. He once said something I didn't understand back then. But the more years I spent in the market, the more terrifyingly accurate it became. When the tide crashes, you see who's swimming naked most clearly. What did he mean? He wasn't talking about price swings or how ugly the chart looked. He was talking about something far more fundamental. In panic, you see which businesses continue operating as usual. That's what matters. Are customers still using the product today? Is cash still coming in steadily? Did the business model get damaged? Can this company survive the winter? Most people react to panic by staring at the drop. How much has it fallen? Buffett reacts by asking something completely different. Is this business still alive? I remember one particular crash when everyone was screaming. A company's stock price had fallen 40%. Someone on the team rushed in, almost breathless. "It's over, this company is done." Buffett didn't look at the chart. He didn't look at the price at all. He simply asked, "Are customers still using it today?" We checked. Not only were customers still using it, usage had actually increased. Because the more chaotic the world gets, the more people cling to the products that truly matter. When I told him the result, he nodded and said, "Then it isn't the business that's dying. It's just the price that's sick." Buffett always sees differently. Chaos doesn't push him to look at numbers flashing on a screen. Chaos pushes him to look at the company's pulse. Munger likes to say, the bigger the storm, the easier it is to see which ships are built well. Panic is that storm, and when it hits, you can instantly see the weak models collapse. Businesses that depended on hype fall apart. Trend-driven companies lose momentum overnight. Firms with thin cash reserves suffocate in weeks. And yet, some companies barely flinch. Those are the ones with stable, repeatable cash flow. Customers who don't leave. A business model rooted in necessity, not excitement. A moat that fear cannot erode. These are Buffett's treasures. During the worst week of that crash, someone handed Buffett a stack of valuation models. He looked at one page and closed it gently. This is not the time to calculate. This is the time to see who's still breathing. Buffett doesn't look at panic through the lens of how far it can fall. He looks through the lens of which business can walk out of this storm. because the businesses that survive the storm are the ones that will survive the decade and probably make you rich for the next two. That's why, when others run for their lives, he picks up what they dropped. Panic is precious, not because prices fall, but because panic creates the only moment when price and value are violently torn apart. In normal times, price and value move like two rails running side by side, close, parallel, predictable. But in panic, price becomes a derailed train, plunging straight into the ditch. Value, however, remains exactly where it always was. That gap, the distance between what something is worth and what people are willing to sell it for, is the birthplace of extraordinary returns. This is the essence of mispricing. Munger once gave a metaphor that sounds brutal but perfectly accurate. In a panic, the market throws out the baby with the bathwater. Imagine someone panicking so hard that they throw out the baby along with the water. This is exactly how irrational the market becomes during fear. If it's a stock, they sell. If someone else sells, they sell faster. If it drops hard, they assume it's dying. If the crowd runs, they run harder. Fear flattens all distinctions. A great company and a terrible company can fall the same 40% in the same week. Not because their businesses changed, but because fear doesn't analyze. Fear only replicates itself. This creates the absurd phenomenon. Companies that are perfectly healthy get priced as if they're going bankrupt tomorrow. Why does this happen? Because panic is a flood of emotion, not a flood of logic. Once the floodgate opens, everything gets washed away together. An old Eastern proverb describes it even more directly. When the water turns muddy, fish are easier to catch. In muddy waters, clarity becomes rare, and rare clarity becomes valuable. This is exactly why Buffett loves panic, not because he likes danger, but because he likes discounts created by danger. In normal markets, great companies are almost never cheap because everyone recognizes their quality. But in panic, the same great companies are suddenly thrown away like scrap metal. Buffett once told me, when the world screams, I start whispering. When the world throws its treasures away, I pick them up quietly. He's not being poetic. He's describing a system. Fear creates forced selling. Forced selling creates mispricing. Mispricing creates opportunity. This moment, when the emotional distortion is at its peak, is the golden moment, because only then can you buy a decade of cash flow for the price of a bad week of emotions. Panic makes the market forget value. Value investors exist to remember it. When the market panics, everything gets dumped together. If you don't know how to filter, you'll see only dirt. And you may even end up picking up a rock thinking it's treasure. Buffett has a filtering method that is shockingly simple, yet lethal in accuracy. He doesn't ask 10 questions. He doesn't run complicated models during chaos. He asks 3 questions, only 3. And these 3 can cut straight through the panic fog and expose real gold. I first heard these 3 questions during a brutal market crash. Everyone was selling. Even conservative funds were dumping positions like their life depended on it. I asked Buffett, "Is this the time should we start buying the bargains?" He didn't say yes or no. He pushed back the entire stack of panic, sold companies, and said, Ask these 3 questions first. If you can answer them, then we can talk. That was the moment I saw what true calm looks like. These are his 3 questions in panic. Question 1. Will this company survive? It sounds simple, but it is the most brutal question of all. Does it have cash? Is the business model intact? Is it still earning money? Is it still essential in people's lives? If the company cannot survive the storm, Buffett will not touch it, no matter how cheap the price looks. Munger once said something very Eastern, very sharp. A dead horse, no matter how cheap, is still a dead horse. During panic, you're not buying what fell the most. You're buying what will still exist after the storm. A company that can survive panic can survive the decade, and time will make its price repair itself. Question 2. Are the customers still there? Buffett never obsesses over trends. He obsesses over habit and dependence. Though customers use it every day, would life be inconvenient without it? Has it become a default choice? Is it a business people rely on even in chaos? In panic, customer behavior becomes the clearest truth. You will often find that the best companies become even more essential when the world shakes. Munger once pointed to a company still adding users during a crash. See, this is gold. Because when customers stay, revenue stays. And when revenue stays, the business lives. A business that people don't abandon doesn't deserve to be sold off like trash. Question 3. Is its cash flow still healthy? Cash flow is the heartbeat of a company, and panic exposes real heartbeat better than any other time. Is money still coming in? Is debt manageable? Does it have enough reserves for the winter? Is the business engine still running smoothly? Buffett says, in panic, treat cash flow like breathing. If a business is breathing, it's alive. Some companies look strong during hype, but panic hits and they suffocate instantly. True businesses, the ones Buffett loves, keep breathing steadily even when the entire market is gasping for air. That steady breath is the glint of gold under the mud. Together, the 3 questions form Buffett's panic filter. Can it stay alive? Will customers stay? Does cash flow stay? If all 3 answers are yes, buying in panic is not risk, it is opportunity. If even one answer is no, you are not buying a bargain, you are stepping into a trap. Munger summarized it perfectly. We're not buying cheap junk. We're buying 10 years of cash flow that just went on sale. Since then I understood panic doesn't exist to make you smarter. Panic exists to stop you from being stupid. Avoid what dies, and everything left is gold. That year, the market fell as if someone had pushed it off a cliff. Every opening bell was a bloodbath. Veteran traders cursed under their breath. Analysts' phones rang non-stop, and the media hammered out headline after headline. Industry meltdown. Corporate collapse, systemic risk. Among the chaos, one company crashed harder than the rest. It wasn't a hype company. It wasn't built on a fragile trend. It had decades of steady revenue, clean cash flow like spring water, and a customer base so habitual that as long as the doors stayed open, money came in like clockwork. But during panic, that didn't matter. It belonged to a sector that happened to be the punching bag of the moment. The sector dropped, so this company was dragged down with it. For days, its stock chart looked like the market was trying to erase it off the face of the earth. Someone from the team burst into the room shouting, "It's over. The whole sector's dead. Even institutions are running. Shouldn't we run too?" I won't lie. Even I felt something inside me shake. You can know a business inside out, trust its model, admire its stability. But when everyone around you is sprinting for the exit, you begin to wonder whether you missed something. So I went to see Munger. He sat quietly, like a man watching a storm he'd seen 100 times before. No panic, no urgency, just calm observation. I put the crashing chart on his desk, a chart so red it looked like it had been drenched in blood. I asked him, "Munger, is this company finished?" He looked up, didn't glance at the price, didn't even touch the chart. Instead, he asked something completely different. "Are the customers still using the product today?" I paused, then went to check. The truth stunned me. Not only were customers still using it, usage had increased, because the worse the world becomes, the more people cling to essential products. When I told Munger, he nodded. If the customers didn't leave, the company didn't die. And if it didn't die, it's treasure. I said, "But the price." He cut me off. Price isn't truth. Survival is truth. Outside, the market was convulsing. Inside, he spoke like he was describing tomorrow's weather. That week, we quietly built a position. No announcements, no heroics, no trading, room shouting, just discipline. We followed the 3 questions. Can it survive? Are customers still loyal? Is cash flow breathing? It passed all 3. So we bought. The next months were painful. The stock kept falling. Or mark. To market numbers got uglier. People mocked us. Some even warned us. You're going to get buried trying to catch this falling knife. But Munger, he didn't flinch. Gold, he said, gets buried deepest right before it becomes most valuable. Time proved him right. 3 years later, one quiet morning, the company released a quarterly report. Record cash flow, record profitability, competitors wiped out. Sector rebounding. It was like the market suddenly woke up from a 3-year coma. Wait, this company is incredible. The stock soared over 200% that year, doubled again the next, and kept climbing for years after. Those shares we bought during peak panic became some of the most beautiful returns in the entire portfolio. A journalist later asked Munger, "How did you know it would recover?" He smiled. "I didn't know how high it would go. I only knew it wasn't dead. And anything that's alive, time will eventually reward." Then he leaned back and whispered something so soft, you'd miss it if you weren't listening. When people panic, they throw gold onto the ground. Our job is simply not to panic with them. That sentence is the entire truth of value investing during chaos. Panic is not created by the market. Panic is created by the human mind. If you watch enough people during a market meltdown, you'll notice something unsettlingly consistent. People don't lose money because they're wrong. They lose money because their own brains betray them. Munger once said a line sharper than any academic theory. People don't lose in the market. They lose in their own heads. During panic, the human brain switches into a faulty mode an ancient survival mode that is disastrously incompatible with investing. There are 4 illusions people automatically fall into. These illusions are invisible chains, and they're why most people will never pick up the gold lying on the floor during chaos. If you can see these illusions, you can survive panic. If you can't, you're done before the market even touches you. Illusion 1. If the price is falling, something must be wrong. Reality, falling price does not equal a failing business. In panic, people instantly assume down equals dead. But in 90% of cases, price drops because other people are scared, not because anything fundamental changed. During one market crash, a company dropped 50%. Someone rushed in screaming, "It's going to zero." Munger didn't even look at the chart. He simply asked, "Did the customers stop using it today?" When he heard the answer, "No, they're using it even more," he laughed. Human nature, when the price goes up, they think it's a god. When it goes down, they think it's a corpse. People mistake price for truth, but price is nothing more than a short-term emotional vote. It is not a business obituary. Gold, when covered in mud, does not stop being gold. Illusion 2. Everyone is running. I must run too. Reality, the more people run, the more valuable staying calm becomes. Humans have a deep evolutionary instinct, herding. When you see 100 people running from something, your brain screams, follow them now. And that's exactly what happens during panic. People don't analyze, they imitate, they sell because others sell. They fear being the last one out. But Munger said, the crowded place is never where rationality lives. It's where fear spreads fastest. You can be intelligent, educated, experienced. But if you stand inside a frightened crowd, your brain will become frightened too. This is the second illusion. Illusion 3. If it keeps dropping, I'll buy. If it bounces, I'll sell. Reality, emotion is not a strategy. It's a trap. The 2 most common lies people tell themselves during panic: just a bit lower and I'll buy. Just a small rebound and I'll sell. Both sound like plans, but they're simply fear dressed as logic. When the price actually drops lower, fear gets worse. When it rebounds slightly, greed returns, so they never buy low, never hold long, never keep conviction. They turn the market into a mirror of their own emotions. Munger said, the market's greatest trick is to convince you that you have a plan when in fact you're just reacting. This is the third illusion. Illusion 4. Short-term pain means long-term doom. Reality, short-term pain is just short-term pain. During panic, the human mind does something dangerous. It extrapolates the present into the future. Today hurts Faye, it will hurt forever. Today is scary Faye, this is the new normal. Today collapses Faye, everything is doomed. This is called emotional projection bias. A company that spent 10 years building cash flow, 10 years building a moat, 10 years earning customer loyalty, gets written off by investors because of a single brutal week. Munger said, short-term fear can erase long-term wisdom. This illusion destroys fortunes put together. What do these illusions create? A market where gold lies on the ground. People walk past it. Some see it but are too scared to touch it. Only a tiny minority picks it up. And years later, everyone envies that tiny minority. But Munger said it best. They didn't buy because they were brave. They bought because they could see clearly. See what? That in panic, Value doesn't fall. Only emotions fall. To understand why Buffett doesn't panic, you must understand one truth. His calm isn't personality. His calm is architecture. Most people panic for a very simple reason. They don't own a business. They own volatility. They don't hold companies. They hold prices. So when prices fall, they panic. When the crowd screams, they panic. When someone else sells, they panic more. Buffett's world is the opposite. His calm isn't emotional discipline. It's structural inevitability. There are three foundations beneath his calm, and once you see them, you'll realize anyone can build similar structures. Not easily, but possible. Foundation 1. He only owns businesses that will still exist 10 years from now. Buffett never owns short-lived companies. Every major position he holds is a business that will still matter in a decade. People will still drink beverages. People will still use insurance. People will still swipe credit cards. People will still rely on railroads. These businesses don't rely on hype, or trends, or narratives, or mood swings. They share one attribute: durability. When panic hits, hype dies first. Trends collapse first. Fads vanish instantly. Pretend innovation evaporates. But human habits, those don't disappear overnight. You may not buy VR. You may not buy the newest gadget. But you will definitely eat, drink, travel, and insure your life. Buffett buys what aligns with human nature. And panic cannot destroy human nature. This is the first foundation. Foundation 2. He never uses all his cash. Buffett always keeps a large pile of cash doing nothing. People criticize him for it. You're wasting capital. You're underinvested. You're missing opportunities. But Buffett knows something they don't. Cash is your weapon in a panic. When panic hits, no one has liquidity. No one has courage. No one has dry powder, except him. When others are in pain, he has ammunition. To him, panic isn't a threat. It's a sale. Munger once joked, except it wasn't a joke. Panic is our favorite season. People panic because they are unprepared. He doesn't panic because he prepares for panic. This is the second foundation. Foundation 3. His sense of safety does not come from the market. Most investors secretly rely on the market to tell them how to feel. If the price goes up, I'm smart. If the price drops, I'm wrong. If others buy, I'm safe. If others sell, I'm in danger. They outsource their emotional stability to strangers. Buffett doesn't. His safety comes from one question: what business do I own? Imagine you owned a small store that earns money every day. Would you panic because a stock index in another country fell 5%? Of course not. Your store still sells goods, takes cash, restocks inventory, serves customers. So why panic? Buffett treats every holding the same way. He looks at the business, not the price. He asks, is it still earning? Are customers still loyal? Is the model still intact? Is the moat still there? If yes, then the price is noise. And noise cannot dictate his emotions. This is the third foundation. Put the three foundations together, and you get Buffett's steel. Like calm, His businesses survive fear. His cash lets him act during fear. His emotions aren't governed by fear. Storm bigger, he remains stable. News louder, he remains quiet. Crowd crazier, he becomes clearer. Munger summed it up perfectly. In panic, everything you see is fake. Only structure is real. Panic doesn't reveal your intelligence. Panic reveals your architecture. Some people crack at the first sign of fear. Some people remain steady. The difference isn't psychology, it's structure. If you watch the market long enough, you'll notice a brutal truth long. Term wealth isn't determined by what you do in bull markets, but by what you don't do in panic. And the greatest enemy in panic is never the market. It's always your mind. Buffett and Munger both believe in a single fundamental law. In panic, the biggest risk isn't the market. It's you. Why? Because panic is not falling prices. Panic is the moment your brain switches into a faulty mode, a prehistoric survival mode that makes perfect sense on a battlefield, but destroys you in an investment environment. During panic, your brain triggers 4 automatic reactions. Each one can ruin you. Each one can make you sell the exact thing you should have held for the next decade. Here are the 4 traps. Trap 1. Your brain exaggerates danger. In panic, everyone experiences the same hallucination. This time is different. This time is the end. Even though markets have recovered from every crash in history, your brain will insist that this time is the exception. This is an ancient instinct. Our ancestors survived by exaggerating threats so they could run faster. But investing isn't running. So an instinct designed to keep you alive now pushes you into self-destruction. You begin to think, it's over. This company will never recover. This is the end of the cycle. Munger said, every short-term panic gets magnified in the human brain as if it were permanent. This is the first trap, trap 2. Your brain imitates the crowd. During panic, your brain enters herding mode. Everyone is running. If I don't run, I'm the fool. So investors stop analyzing and start imitating. Are people selling? Are funds dumping? Is everyone escaping? Nobody is asking, what is the business actually doing? Munger said, the crowd is never where rationality lives. It's where fear spreads fastest. No matter how smart you are, once you stand inside a frightened crowd, your brain becomes frightened too. This is the second trap. Trap 3. Your brain mistakes emotions for strategy. The 2 most common phrases in panic are, if it drops a little more, I'll buy. If it rebounds a little, I'll sell. Both sound logical. Neither is real. They're just fear masquerading as planning. When the price actually drops, you panic more. When it actually rebounds, you hesitate or sell too early. In panic, your plan changes every hour because it was never a plan. It was your emotions holding the pen. Munger warned, the market's greatest illusion is making you think your reactions are strategies. This is the third trap, trap 4. Your brain turns short-term pain into long-term doom. Humans project their current emotion into the future. Today is scary. The future will be scary. Today is painful. The future will be painful. Today is collapsing. The future is doomed. This is emotional projection bias. A company that spent 10 years building cash flow customers, Omaha Notes, gets erased in your mind because of a single bad week. Munger said, "Short-term emotion can wipe out long-term wisdom." This is the fourth trap. Put these four illusions together, and you get the real reason. Most people lose. Gold lies on the ground. They walk past it, or see it but can't pick it up. And years later, they envy those who did. The problem isn't the market. The problem is the brain inside the investor. Buffett doesn't stay calm because he's superhuman. He stays calm because he understands this. During panic, you're not fighting the market. You're fighting yourself. And whoever can defeat their own panic wins everything panic leaves behind. In the world of investing, there is a harsh unspoken rule. Your long-term wealth is not defined by what you do when markets rise, but by what you don't do when markets panic. And the truth behind every major fortune is simple. Opportunity never appears in calm waters. It only emerges when fear tears the market apart. Why? Because only during panic does emotion rip price away from value, creating a gap wide enough to shape someone's entire financial future. This gap is rare, but every time it appears, it divides people into two groups, those who run and those who rise. Munger once told me, in the middle of a market meltdown, when the world goes insane, that's when rational people make money. You think he's being dramatic the first time you hear it, but after living through enough crises, you realize he was describing a law of nature. What is panic? Really? Panic is not violent price drops. Panic is not red screens. Panic is not headlines screaming doom. Panic is a moment when the market becomes irrational, blind, chaotic, a moment when the collective mind stops thinking. In that moment, people stop analyzing. They stop evaluating. They sell good and bad companies alike. They let emotion decide valuation. They throw everything overboard to stay alive. And it is precisely in that blind chaos that great companies get mispriced the most severely. Not because they failed, but because fear doesn't care about fundamentals. Panic is not a failure of companies. It is a failure of judgment. So why can't most people pick up the gold? Because fear blinds them. When the market screams, people don't see value. They see danger. They don't see a healthy company being discounted. They see the possibility of more pain tomorrow. They don't look 10 years ahead. They stare at a red chart from the last 10 minutes. Fear turns investors into short-term animals, and investing requires long-term humans. That's why most people walk right past the gold. Some see it but don't dare to touch it. Only a tiny minority bends down and picks it up. And years later, those are the people others call lucky. But Munger once whispered to me, they weren't lucky. They just weren't blind. Why can Buffett pick up the gold? Not because he's fearless, but because he sees clearly the business didn't die. The customers didn't leave. The cash flow didn't stop. The moat didn't break. Only the price fell, not the value. And when price falls far below value, that is not risk. That is a gift. His greatest investments were made when other people were too afraid to even look. not because he predicted the bottom, but because he understood the distortion, not because he was braver, but because he was calmer for longer. In markets, being calm for 10 more seconds is often the difference between an ordinary life and an extraordinary one. What happens after panic? Every panic, no matter how violent, eventually ends the same way. Markets recover, value reasserts itself. Fundamentals reappear. Fear fades, prices correct upward. And those companies that were wrongfully buried are dug back up and rediscovered, and revalued and bid up again by the same crowd that once threw them away. But by then, the gold is already in someone else's hands. Buffett once said, "Gold never waits for everyone to calm down before it shines. It shines in the middle of the chaos." That's why so few people benefit from it, because they cannot bring themselves to look down while everyone else is screaming. So what is the real lesson of panic? Not how to buy the dip, not how to predict crashes, not how to time the market. The lesson is, panic is not a disaster. Panic is a reward for the prepared. If you can hold on to 4 things, the business is alive. The customers are loyal. The cash flow is steady. Your mind is clear. Then panic becomes not something you fear, but something you welcome. Buffett doesn't pick up gold in panic because he is superhuman. He picks it up because he built a structure that stays standing when others fall. That structure wins every time. And when the next market panic comes, as it always does, may you hear the same quiet sentence he once said to me: "The air is full of discounts."